Okay, here's number 7, and now we are going to kind of show how this plays out if somebody does, well, let's see how it will. If somebody, first of all, you write them off, and then they decide to pay, and you have to put it back in. Now, this is using an allowance account. If you were using direct write-off, it would not be this easy. So, on July 19th, you decide to write off Steve Stone. He's just, it's not going to happen. So, you take it out of your allowance for uncollectibles, and you take it out of receivables. The uncollectibles have a credit balance, so by debiting it, you lower that. And the receivable has a debit balance, so you lower that by crediting it. On December 31st, Steve shows up and decides, hey, I'm going to pay it, with a little persuasion. So what then happens is you have to reverse everything you've just done. So this gets reversed, so you have to put Steve back in, and you have to increase the allowance again. Then you're going to show receiving the cash, and then you would show taking it out as him paying it. This is very easy to do. It's very clean. It's very transparent. With the direct write-off, it's a little more difficult to pull that off because of the timing differences with the expenses and your financials. So we're going to move on, and we're going to look at, we're not doing 8, and we are going to look at what happens when you have credit cards, and you have a credit card expense or a fee that is that you have to pay for using that, for accepting that credit card. And those fees do vary, so they give you 2 cards. One has a 2% fee on it, and the other has a 1.5% fee on it. So they're going to ask you to make the adjustment on the sales account, and in this case it shows it as an accounts receivable, and in this case it shows it as a cash. So what you'll want to do is find, it gives you the amounts. So the first one has an accounts receivable, and it's actually going to show a credit card debt expense here. Now the other one is a cash, so it goes directly into cash, and it shows it as a discount expense also, but instead of you're going to directly debit the cash for the amount and put the discount expense in, and then you're going to do the revenues. So you can see that they both work the same. It's just that one shows it going into an accounts receivable, and one shows it going into a cash. I'm trying to remember why they have separated the two out, showing a cash and a, let me see, one is a credit card and the other is a bank card, like a debit card. That makes sense. So you've got a credit card, and this would be a debit card somebody has used to pay for, say, pay for their purchase. So you can see the two differences on how that's set up. It wasn't really explicit in there other than it said credit card versus bank card. But that will give you a good idea how that's handled, and this is a very common entry anymore. Very few people actually carry cash, so that's 9. And a short explanation about it. On 10, we are jumping to a brand new ball game, and we're looking at notes receivable and how to figure the interest. These are fairly well straight out and out calculations. This one's being held for 10 months. This one's being held for 75 days. This one's being held for 90 days. And this one's being held for 5 days. Please note, you don't use the 365 day, you use the 360 day in this one. So I think you can probably pull that one off just to kind of get a feel for doing the interest. and we're skipping 11, and we're doing 12. And 12 is looking at ratios. And ratios are fun because that's why we do the financials, so we can do some ratios and do some comparison and seeing how well the company's doing. There's the acid test ratio, and we actually give you what you need to do. You need to take cash plus short-term investments plus the net current receivables and divide it by total current assets. After you do all the calculations, you should come up with 1.19. So that'll kind of be a check figure for you to make sure you're heading in the right direction. And then they want to know, is that strong or weak? What is that? Read the book and see what the book says, and the suggestions for the book. The other one we ask you to look at is the, what are we doing here? Days sale and average receivables. And this one's a little bit trickier, and it's kind of confusing. Up here we use the 360 day a year, and down here they're actually using the 365 day year. And the banks usually use the 360. Whereas businesses, when they're doing ratios, will usually use the 365 for their days in the year. So that can be confusing. Wherever we have a question mark, see these question marks? Those are the numbers you need to find. And to find the net sales revenue and divide it by 365, that's a given for you. Okay? That gives you $7 a day. That's one day's sale, and that would be in thousands, I'm sure here. Then you're going to take the average net accounts receivable, and that involves taking last year's balance and this year's balance in accounts receivable and dividing it in two. You add those two together and divide it in two, and that'll give you the average net over that year's period. And then you divide that number by the sales per day, and then that will give you what we're looking for when you look at this day's sales in average receivables, because you're looking at what is our average sold per day, right? And then taking the average of the net receivables to come up with a day amount. So those are just kind of a plug-in chug, I call them, but you have to know which number to pull and what to do with those numbers. And we're coming up on 8 minutes. I think I will end this, and we will start up with 13 in the next video.